Welcome to the Deep Dive. Today we're tackling something a bit puzzling, actually. Why haven't those recent U.S. tariffs on imported durable goods, the big stuff like cars, fridges, TVs, why haven't they made prices jump for shoppers here? It really seems like they should have. We've gone through a load of articles, economic studies, specific data points to really unpack why this is happening and what it signals for the economy.
Exactly. The central question really is, why are foreign manufacturers apparently just, eating these tariff costs themselves? Why aren't they passing them straight on to you at the checkout? It tells us a lot about market dynamics.
Okay, so let's dive in. How do we figure this out? I think we need to start with the consumer side, right? With how you, the shopper, behave when it comes to these big-ticket items. I mean, a refrigerator or a car, these are things you buy once in a while. You buy one, you have it. You're probably not rushing out to buy a second fridge just because it's slightly cheaper.
Precisely. That's what economists call inelastic demand. Basically, for these durable goods, even a pretty big price cut isn't going to make you suddenly buy, say, 2 cars instead of 1. Your need is already met.
Right. So the knock-on effect is, when tariffs make imports more expensive, American households don't just immediately pivot to buying American-made instead. Often they just wait, they delay the purchase, or maybe cancel it for now. And that lack of strong reaction, that inelasticity, it really ties the producer's hands when it comes to raising retail prices.
And then you flip it over to the supply side, and you see why the factories abroad are the ones absorbing the hit. Think about these massive appliance or auto plants.
Huge operations.
Huge, running thousands of units a day. They've got this gigantic, very inflexible production capacity.
Yeah, and shutting down or even just idling one of those lines because of tariff, that's incredibly expensive for them, much more than just taking a hit on the margin for a while.
That's exactly it. They face this choice, and often it leads to what you could call maybe margin-preserving desperation. They have to slash their own profit margins, eat the tariff, like we said, just to keep the production lines moving, avoid those shutdowns, and crucially, hold on to their market share.
And we're seeing proof of this in the numbers, aren't we? If they were passing the costs on, we'd expect to see wholesale inflation, producer prices really spiking globally.
But we're not seeing that spike. In fact, the data is showing the opposite. Global producer prices are generally falling or stagnating. Look at China factory gate prices down 3.6% in June. That's the 33rd month in a row of deflation there.
33 months.
Yeah. And you see similar trends, maybe less dramatic, but still downward or flat, in Japan, the Euro area, South Korea. Their export prices are falling too. It all points to exporters squeezing their own profits, not raising prices for importers like the U.S.
Okay, so if we put those two pieces together, the consumer who waits and the factory that can't easily stop producing, what's the underlying economic idea here?
It's a textbook example, really, of what we call asymmetric incidence of a tax, or in this case, a tariff. When demand is inelastic, consumers don't react much to price and supply. As elastic producers can adjust volume but face high costs for stopping the burden, the incidence falls mostly on the producer.
So, put simply, because the foreign factories can't just easily turn off the taps without big losses, they end up absorbing most of that tariff cost themselves.
That's the dynamic, and studies back this up. Looking at previous tariff rounds, like the U.S.-China ones in 2018-19, they found only about, say, 20 to 30% of the tariff actually made its way into U.S. consumer prices for these kinds of durable goods.
Right, so it's this unique mix. You, the consumer, being hesitant on big purchases, and the foreign factory being almost too ready to produce, that forces the exporter to swallow the tariff cost.
And keeps those retail prices, the ones you actually pay, relatively stable despite the tariffs. It's quite a specific outcome.
Okay, but it doesn't stop there. This whole situation seems to be having wider, maybe even positive effects on the U.S. economy overall. We're seeing maybe 4 key things boosting GDP. First up, net exports look better.
Right, U.S. imports of goods actually fell 4.2% in June. Exports only dipped a little. That narrowed the trade deficit significantly and added almost 5 percentage points to Q2 GDP growth. A huge contribution.
Second point, the tariffs themselves are bringing in money, right?
Yeah.
A kind of fiscal windfall.
A big one. Tariff collections hit $113 billion gross in the first 9 months of fiscal 2025. That's nearly double the year before. More revenue for the government. That feeds into the GDP picture too.
Third, like we discussed, those producer price trends confirm companies are soaking up costs. U.S. producer inflation actually eased a bit in June, even after tariffs went up in April. It suggests corporations are absorbing hits rather than passing them all on.
which helps keep overall inflation contained. And fourth, there's this new legislation, the One Big Beautiful Bill, as it's nicknamed. It allows businesses to immediately deduct 100% of the cost of certain investments, think AI, semiconductors, green tech.
Ah, the immediate expensing.
Exactly. It's called 100% bonus depreciation. It's a massive incentive for companies to pull forward their capital spending, buy that new equipment now, which directly boosts investment in GDP, likely starting in Q3.
So putting all that together, the trade balance improving, the extra tariff money, contained inflation from producers absorbing costs, and this investment push. Yeah. What's the outlook? What does it mean for Q3 GDP?
Well, when you add it all up, it paints a surprisingly strong picture. These forces combine the export boost, the fiscal cushion, the inflation check from corporate absorption, and the incoming capex surge. They really set the stage for U.S. GDP growth to stay pretty robust, possibly holding around that 3% pace we saw in Q2, maybe even a bit higher. Q3 looks quite solid.
So the big takeaway from this deep dive is pretty unexpected, isn't it? This complex dance between your buying habits for big items and the realities of global manufacturing means these tariffs, well, they haven't really hit your wallet the way most people probably assume they would.
Well, it certainly challenges the simple view. And it leaves us with a provocative thought. If tariffs, in this specific context of durable goods, are largely absorbed by foreign producers and might even coincide with a boost to U.S. GDP through these various channels, what does that imply for trade policy debates going forward? Or how might global companies start restructuring their supply chains if this dynamic persists? Something to think about.